Bond yields have been on a steady rise this year, with the 10-year holding above 4.6%. So how high do yields have to go before investors begin to worry about stock performance? Joining us now is George Goncalves, who is the MUFG head of U.S. macro strategy. George, great to have you here with us. So when,
good to be on.
Absolutely. So when do we begin to see selling with bond yields, bonds yielding more than the S&P's earning yield?
Look, I think that the earlier segment with Jared and a lot of the points he made are really spot on. That 4.75 level on the 10-year would be a both psychological as well as an early warning signal that rates are going in the opposite direction than where the Fed wanted them to go. Let's remember that the Fed cut 100 basis points in a matter of 3 or 4 months, and rates went up 100 basis points, completely at odds and not really helping out the interest rate sensitive sectors of the economy. Housing was really looking for that sort of boost. Commercial real estate was looking for lower rates to help out their cause. And also, look, the small caps have had a hard time, and a lot of it has been on the back of this rise in rates. And so the rates channel will matter if we break above 4.75.
George, is that going to put a halt into this broader market participation story that we have long been waiting for? And I've started to see glimmers of hope about here, but they do fade quickly.
Yeah, no, that's also a great point too. I mean, to kind of see a broadening out of the rally across different sectors in the equity space would make it feel like it's got more potential and more legs and become more sustainable. And so this is why that rate channel is super critical. I also think that the dollar will also be super important too. And then which industries are going to really be impacted first, depending on what sort of executive orders or sort of new policies that come out of Washington. And so there's a lot still at play. I mean, we kind of just joke around that this is the first week of the year, as we all know, and it's the first big macro week. But let's be honest, January 20th and onwards is going to be the start of 2025 in many regards, right? So I feel like we're in this kind of holding pattern still. As long as we don't break that 475, the dollar kind of stays here, then maybe we can kind of just trade sideways. But I don't see we accelerate one way or the other until we get more clarity.
What are the sectors to lean into when you see a holding pattern like this?
Look, I think being defensive makes sense. Look, utilities have had a good correlation with rates. Let's say rates don't break above 475. That would be, I guess, a way to kind of hold things out. I also think that the banks in general are benefit from the environment that lies ahead. Both from rates are going to stay higher than they would have been, all else equal, as well as there's hope for deregulation and just further lending and growth in that area. So I think the banks in utilities.
George, when it comes to some of those earnings growth expectations, technology obviously really front and center here when you take a look at the fact that the expectations here are for the earnings growth to reach just 18%. And I say just 18% because that's in comparison to the 34% growth that we saw last year. How big of a risk do you see this posing or potentially being here to the broader market?
Yeah, look, having such a concentrated market as like we've had has both helped and potentially hurt us going forward, right? Because now we have this concentration risk around earnings potential, and and we have lofty valuations. Let's not deny that fact, right? And so I do think it does kind of goes back to your earlier point. If we don't see the broadening out of the rally, and we have this concentration risk, it does set you up for at least some sort of temporary pullbacks. And I think that's the risk for 2025. That a lot of euphoria post-election. A lot of euphoria that we're going to see this kind of momentum continue both in the economy and markets. But what if a lot of that's priced in?
If we see growth deceleration, how would that then pass through to some of the right sizing of valuations?
Yeah, so I think it's going to be at the broader, larger indices, right? And I think that's where you're going to see most of the adjustment, be it the NASDAQ or the S&P. So that's really where you're going to see it first, front and center. But I do think that we are at a point where if interest rates were to come back down, that will give you some sort of relief. But yeah, there's a lot of factors up in the air, and I think that people have to have an open mind at this point, and look to try to diversify a little bit and not just be so concentrated.
All right, George, thanks so much.
Thank you.